As we start the year, recession fears are rising, questions surround the Fed, and equities remain unpredictable. We'll dive into these topics right now. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastori. Octavio Morenzi is my guest for today's show. Octavio, great to have you on the show with us, and good to have you back. And I wanted to start with you right away with the Fed, Octavio, because clearly any viewer of ours and anything that you're talking about here, we know the Fed ended the year last year in 2022, and certainly the Fed in the news is beginning 2023. We can't get away from the conversation about the Fed tightening, inflation, and all that. And interestingly, markets are now pricing in a 75% chance that the Fed is going to raise rates by 25 basis points in February versus the 50 in December and the 75 we saw most of last year. The question I have for you is, do you expect that they're going to keep up this pace of this slowing of quantitative tightening? And when do you think the Fed is actually going to perhaps pivot again?
Well, listen, I'm not really sure quite what to expect from the Fed. And I think Jay Powell back in, I think it was November, made a stunning admission that basically the Fed's models had been all wrong about forecasting inflation. They had underestimated how high it was going to be and how long was it going to last. He also said that was true of the private sector as well. Now, he started his speech by saying that. He said, inflation's been really bad. It's really bad for the economy. People hate it. We've been wrong about it. And now, therefore, we're going to only increase 50 basis points rather than 75. It was a bit of a non sequitur. It didn't make much sense what he was saying there. But I thought it was a really interesting admission. So the question becomes, how does the Fed really steer interest rate policy? Because it looks like they're really fine-tuning things 25 basis points here or 50 basis points there, at the same time admitting our models don't work very well. We're not really sure where we're going. So I think the Fed is going to be just sort of very reactive to current events, to political trends and things of that sort, rather than really having a firm model in mind and a firm target. So I think they're going to bounce around a bit. But I do think interest rates are going to keep going higher. Inflation is going to remain stubborn. And I don't think we're going to see a terminal interest rate of 5% the way some people are thinking. I think we're going to go 6, 7% and maybe even higher.
Yeah, and it's interesting you say that, because over the past week, a couple of Fed officials said that they expect that rates will be going higher than 5%, including Atlanta Fed President Raphael Bostic, who literally said, and I quote, that rates should stay above 5% for a long time, adding he was not, quote unquote, a pivot guy, which we're using the word pivot quite a lot these days. And look, the Fed can't ignore inflation. We had CPI come out recently, 6.5%, which is well below that 9% that we saw late last year. So it seems like we're moving in the right direction. Even PPI coming in, that producer price index, at a decline of 0.5%. So, I mean, what else could the Fed be looking at? I mean, wages obviously are something they're paying attention to as well here.
Yeah, definitely. They're going to be looking at wages very carefully. They're going to look at all these factors. Some people have this idea that the Fed takes an inflation measure, whatever their preferred measure of inflation is, sticks that number into an econometric model, and it spits out the answer in terms of what interest rates should be today. In reality, things are a lot less scientific than that, and is much more of an art than a science. And there's all sorts of other factors that take into account and weight in different ways, basically by gut instinct and feeling more than anything else, I think. And that's what really comes to the fore. And that, of course, makes it very difficult to predict if that's the way they're going to do things. Otherwise, they could just share their models with us and we'd know exactly what interest rates are going to be right down the line. But unfortunately, that's not the way it works. It's not just a straightforward numbers game where you crunch in numbers that you put in. It's not the way they're set up to work.
Yeah, that would be a nice thing, Octavio, if they shared the models with us. Then we could all be much more informed about their way forward. But as you said, I think maybe even they're not 100% sure about the way forward at this point, as we are also not. Which begs the question then, there's a lot of chatter out there about recessions. There are some economists who think that we are already in one, some that may think that maybe we won't see one until midway through the year. What are your thoughts here? Are we currently in a recession, or do you think we still have time to go? Or do you think there may not be one at all, as some are expecting?
Well, I think this increasing of the interest rates almost dramatically brings with it a recession, because there's a lot of businesses out there that either consciously or unconsciously have become really dependent on very cheap credit, and that over a very extended period of time. And once you sort of take that away, there's a whole bunch of business models that can't operate anymore. So let's say, for argument's sake, I'm a car dealer and it works really well when I can borrow money at 1.5% and I can finance my car inventory and sell that. Suddenly I'm confronted with 6-7% interest rates, and my business model falls apart. Now, I didn't knowingly take advantage of the Fed and low interest rates, but just inadvertently, that's just what happened to me. And there's all sorts of business models like that around the country that are going to have to suffer and have to be rearranged. Now, how quickly that happens, I'm not sure, but there is a painful readjustment period there where people have to get used to higher interest rates and find other ways of operating and financing things. So I think we are going to see a recession. I think that is almost certain. Question, how deep is it going to become? I mean, people's forecasts are all over the place. Just in the past summer, Jamie Dimon, for example, was saying that he was expecting an economic hurricane, that things were going to be really very, very bad indeed. If you look at JP Morgan's most recent Q4 earnings, they look pretty tame. Delinquency rates on credit cards and corporate loans were pretty low overall. So that economic hurricane has not arrived yet. Maybe he's still expecting will, but he's walked that back a bit. I mentioned him just as an indicator. I think all sorts of economists and heads of banks and things like that have done similar things, and we have predictions all over the place. It's a very, very tough environment to make any sort of projections at the moment.
Right, and even wage growth itself sort of, slowing down remains a little bit tentative because of the nature of the actual jobs that we're measuring right now. So it's an interesting point, as you said, that there's still a lot of questions out there. Do you think, Octavio, that the markets, specifically the equity markets, have priced in this recession already?
I think the recession is priced in, but I think they might well see the recession as being a good thing for the markets, sort of perversely and paradoxically, because that will then motivate the Fed to pivot, as we pointed out, pivot away from increasing interest rates. So I think the Fed is waiting to see that, the economy to slow down. And if we do see a severe recession, there will, of course, be tremendous pressure on the Fed to reverse its interest rate policy and start lowering interest rates again. And that will be very good for equities and for bond prices. So I think, yes, that is factored in. People are expecting to see that and are expecting to see some sort of pivot in 2023. I'm not convinced it's going to come. I'm not of the school of thought that the Fed is actually going to start to lower interest rates again in 2023. But there's a lot of market participants who are betting on exactly that happening.
Yeah, we'll have to see who's right at the end of this story, and it'll be certainly one for the history books. And we're looking even at earnings headwinds. Our CIO here at UBS expects, between the aggressive Fed and the normalization in demand for goods. And let me ask you that question, because when you look at fourth quarter earnings, what are your expectations?
Well, we've saw just recently now the banks come out with the big banks came out with their fourth quarter earnings, and that's sort of a really good indication of what's going to come for the rest of the economy, because so much of the payment system go through the banks. They see all that money churning back and forth through the system. So they're looking at JP Morgan and Citibank and Bank of America's debit and credit card spending numbers gives you a pretty good indication of what's going to happen in the retail sector and where that's going to be. So if you look at that, it looks pretty robust overall. I think much more robust than most people anticipated. I mean, corporate payments are up 15% overall, so business payments up 15%. And on the credit and debit card side, we saw almost 10% increases in terms of volume. So that is kind of encouraging. Now, I saw retail numbers come out recently that were not that good overall, but at least the banks are seeing that spending happening. So I think that portends relatively well for the economy that's holding up much better than many people expected it would. The other thing that we see in the big bank earnings that is really interesting is that delinquency rates are still at very, very low numbers. They're inching up a bit for retail customers on their credit card balances, but they're still at, historically speaking, very, very low levels. And on the corporate lending side, numbers are very, very low indeed. So that's very encouraging as well. It seems that there are not many bankruptcies and defaults and delinquencies on corporate lending in the banking side. So that's a very good sign as well, I think, overall.
Octavio, thank you so much. Great conversation. I hate to cut it short, but there is a lot. We could talk about this for certainly longer than we're given time to do today. So, Octavio Morenzi, thank you very much for joining us. We hope to see you soon.
Thank you so much.
Great to have you. And if you'd like more information, certainly we can provide that for you on our website, particularly from our Chief Investment Office. You can go to the investment research section of our insights page at ubs.com/views. Plus, there's more information on our social media pages, LinkedIn, Facebook, Instagram, and Twitter. Plus, you can check out all of our past UBS Trending episodes on demand. And if you have any questions about anything that Octavio and I spoke about today, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. Remember to keep your eyes on what's trending. We'll see you soon.